Welcome to Item 2. Today we're discussing and analyzing Showtime's Black Monday, Season 1, Episode 1. Let's recap. The series is set in 1987 and shows the suicide of a trader after Black Monday when the market crashed. We don't know who this is, and the entire season is told in flashback form. The episode begins with a typical montage of workers in 1980s New York City getting ready or heading out to work on Wall Street. Three main characters are shown: Mo, or Maurice, played by War Machine, Blair, and Don. Mo is the CEO of a trading firm. Don is his head trader. Blair is a Wharton MBA with an algorithm that is the talk of all the investment banks on Wall Street. It's Mo's 39th birthday and Mo wants to acquire a company called Georgina Jeans. Don thinks it's a tough buy because a majority share is owned by Lehman Brothers, who hate Maurice and his firm. After fighting with his team, Mo says he's going to go acquire the block from Lehman Brothers. On his way out, one of his traders, Keith, gifts him a 2-ounce bag of Coke. Mo then goes to the Lehman Brothers and buys Georgina at $18 a share for 2 million shares and agrees to pay the $36 million in cash by the end of the day. It's currently trading at $6 per share, and he's buying a 30% block. Meanwhile, Blair is interviewing with top investment banks, such as Morgan Stanley. Blair ends up colliding with Mo on the trading floor, spills his birthday cocaine everywhere, and as a result, Mo gets angry, embarrasses Blair in front of all the traders, and makes a threat saying that if anybody hires Blair, Mo will stop doing business with them. Since Mo's firm is number 11th firm in the street, they all take him seriously. Next, we see Blair going home to his girlfriend, who shames his masculinity and makes him go back to get a job on Wall Street, regardless of what Mo is saying. So Blair goes to Jammer Group's office, Jammer being Mo's company, and confronts Mo and his team. Mo makes him a bet. Mo says he'll give Blair $50,000 to test his algorithm, and if he can double that money in one day, he'll get a job. If he doesn't, he'll have to give up his Honda Civic. Then we see Mo head out to get some cash to pay for that 30% block. He ends up going to the Yakuza and loan shark types. Concurrently, Blair's algorithm is trading really well and takes the portfolio from $50,000 to $98,000. With only a few minutes left in the market, everything starts going crazy and it tanks all the way down to 84 cents. Mo delivers the cash to the Lehman Brothers and gets their block of Georgina Jeans as a result. He starts to gloat, but then the Lehman Brothers inform him that the company is a white whale. Seemingly dejected, Mo heads back to his office, finds Blair outside sulking. Mo encourages Blair to propose to his girlfriend, offers him a job, but keeps the Honda Civic. The episode ends with Mo sitting alone instead of going out for his birthday party, looking at some pictures of the Georgina family. It turns out that he is playing the long game and Blair is actually dating the heiress of Georgina Jeans. Now, the concepts. Mo owns a trading firm on Wall Street. A trading firm buys and sells financial assets, things like bonds, corporate stocks, futures, options. These firms, or divisions of big investment banks, are more accurately called sales and trading firms, or the sales and trading department. The sales side are the brokers who cold call high net worth individuals and sell to existing clients. They take a fee off of the buying and selling activities of these clients. The buy and sell orders are sent to the traders on the trading side. The trading side is where the people are in the pit or on computers making the transactions happen between buyers and sellers in the open market with their clients' money as well as their own money. That part's known as proprietary trading or prop trading. So in the episode, Mo's plan is to acquire Georgina Jeans because they have factories and warehouses that are operating in New York City. The company's product has been irrelevant for several years, but the land is worth 3 times the company alone, if they could sell off the real estate. What Mo needs to do is obtain the majority share of the company, shut down the operations, and sell off the pieces of real estate. By doing this, he's not really acting like a trader at a trading firm, he's actually acting more like an activist investor or a private equity firm. He's buying a majority stake or a percentage of a company and making executive and managerial decisions to make profit on his initial investment. He pays a 200% premium on the shares from the Lehman Brothers because he thinks he can make $300 when he breaks it up and sells it. He's told by the Lehman Brothers that the Georgina family actually owns 51%, but it's hidden in shell companies. The amount in circulation that he could buy is only 49%, giving him less than the majority of the shares and prohibiting him from making the decisions. So let's see if this long game with him using Blair to get Georgina's shares that are hidden in shell companies works out. For Blair, his algorithm is the talk of the town. This is a computer program that he's made that will buy and sell stocks automatically if they see specific patterns. Maybe the program will end up buying a stock if it sees a large volume of interest, or maybe it'll sell if the opposite is true. There could be a lot of different patterns that he'd programmed into it. His algorithm goes up with the market but dies when the short sellers come in near the end of the day. This means traders who are looking to make money on the price of the stock going down. They do this by borrowing the shares and selling them. If they sell them for $100 per share and the stock goes down to $50 per share, they net $50 per share because they only have to buy back the shares at half the price to return the shares to where they borrowed them from. After his application bombs, Don calls him the worst trader in Manhattan since the Indians, referring to how the Dutch famously bought Manhattan for $24, about $1,000 in 2019. Some examples of consumerism. A couple of products to discuss. 1 kilogram of cocaine in the 1980s cost about $30,000, meaning a gram of cocaine was about $30. Mo seemed to have 2 ounces, about 56 grams. That would cost about $1,700 in the 1980s, and equates to $4,000 in 2019. There's a brick cell phone that Blair is given by Morgan Stanley as part of his job offer. That cell phone would cost $10,000 in 2019. Finally, there's a Lambo limo owned by Mo that he gets driven around in. There's nothing really equivalent to that available. There is a Lambo Aventador limo that you can get custom pricing for in 2019 is about $1 million. A couple of terms from the episode. You hear the term chop shop a lot. That's a Wall Street term. It refers to a firm that works their analysts to the bone, then throws them out once they're burnt out. Another term that you hear a lot in Wall Street is the term dog, referring to a stock. So when they're saying dog, they're really saying shit, like the stock is shit, meaning it's underperforming. From the phrase dog shit. Instead of saying the whole thing, they just call it a dog. They also often say dog with fleas, so you get the idea. If there are any TV shows, movies, topics you would like covered in the future, please let me know in the comments. Please subscribe, and for announcements, check out my Twitter